Welcome to the Business Scholarship Podcast, interdisciplinary conversations about new works in the broad world of business research. I'm your host, Andrew Jennings. If you like what you hear today, please consider subscribing to the podcast or sharing with others who might like it too. And if you have ideas for future episodes, let me know. My email address is andrew@andrewkjennings.com, and I look forward to hearing from you. Our guest today is Dorothy Lund, Assistant Professor of Law at the University of Southern California's Gould School of Law. We'll be discussing her article, Nonvoting Shares and Efficient Corporate Governance, which was recently published in the Stanford Law Review. I'll include a link to the article in the liner notes for today's episode. Dorothy, welcome to the Business Scholarship Podcast.
Thank you so much for having me.
As I mentioned in the intro, you recently wrote an article, Nonvoting Shares and Efficient Corporate Governance. Before we get into the meat of the discussion, could you introduce to the listeners the idea of voting and non-voting shares in a capital structure, what that implies for firm value, and maybe what some of the motivation behind this article was for you?
Yeah, sure. So the default under state corporate law is for every shareholder to get one vote. So that's known as the one share, one vote default. But that default can be modified. So a company can go public with a completely different equity structure. They can have non-voting shares. So those shares would have 0 votes. And on the opposite end of the spectrum, they could have 10 times as many votes. These are known as super voting shares. And so a good example of a company that's gone public with all of these is Alphabet. So it used to be known as Google, now Alphabet. And Alphabet actually has 3 different share classes. So they've got Class A, which is 1 vote per share, kind of that standard default rule. And those can be purchased by anybody. But then the insiders get to have these Class B shares, the super voting shares with 10 votes per share. And there's also a Class C, which is non-voting. And the non-voting shares, although they have different voting rights, they have all the other same rights and entitlements, cash flow rights, legal rights, as the shares with votes. So the key difference there is that you're entitled to the same cash flow. You usually get equal treatment in the event of a takeover, but you just won't get any say in be able to vote in annual meetings.
So it sounds like maybe to have a simplifying example, let's say you and I and a third person start a company together, and there are 3 share classes. One is a non-voting share, another is a 1 share, 1 vote, and the other is a 10 vote per share. And you get the 10 vote per share, and I get the 1 share per vote, and somebody else gets the non-voting share. Our economic interest in the company would each be 33.33%, but you having the 10 vote share would be able to call the shots in electing the board and voting in our annual shareholder meeting.
Exactly. That's exactly right.
So you discuss in the article that this is not a recent innovation, that companies that the idea of a dual class equity structure has been around for a while, and that there's been some opposition. It's been something that hasn't really gotten off the ground in a big way. What's some of the history behind that?
Yeah, the history behind this is actually really interesting. And the more that I looked at it, the more I started to see that dual class has been used in different ways, sort of at different times in history, and that in the paper I refer to this as cycles of innovation in dual class structuring. So it's being used to respond to different problems or different business conditions, and each time that you've had this cycle of innovation, there's been a public backlash and some kind of regulatory restriction. So, the first kind of wave of this was at the very beginning of the 20th century. And here there was a rise in dual class companies, and this was thought to, the justification here was actually very different from what we're seeing today. It was used by the bankers who were taking companies public to, keep control with those banks And so the justification was, this is necessary. We're providing reputational services, at a time where there wasn't a lot of disclosure. There was pretty weak corporate law. So these bankers justified this as efficient. But of course, this also generated a huge backlash. People said, this is the money trust keeping excessive control over American business. And that backlash actually resulted in the first regulatory restriction, pseudo-regulatory restriction of dual class stock. That restriction came from the New York Stock Exchange. And the stock exchange said, if you want to be listed, you can't have differential voting rights at all. And that policy was in place from 1940 until 1986, so nearly 50 years. So that was, sort of the first wave. There's another wave around that same time. 1986 was the height of the takeover wave. And so companies started using dual class this time as a takeover defense and started engaging in these recapitalizations. And this led the SEC to become interested. The SEC took a look at this and said, we're going to now adopt a Rule 19c4, and that's going to require stock exchanges to exclude dual class companies. And that rule was in place for much less, a much shorter period of time. It was overturned 2 years later by the D.C. Circuit, said, this is outside of the SEC's authority. And then this kind of ushered in this new period of giving companies freedom to utilize dual class. But the ones that did, the business justification was, well, we're a family-owned company and we want to keep control of our family. Or certain media companies like the New York Times said, well, we want to have dual class structuring to protect our journalists. And then Alphabet went public in 2004, and they broke the mold and broke the mold in a lot of ways, but they did in equity structuring as well, because they were the first technology company to use dual class structuring for to keep power with these visionary founders. So they they kept again all of those super voting Class B shares with the insiders. They sold only low voting stock to the public. And that was, for a new purpose, to insulate these visionary founders from market pressures. And this kicked off a huge wave of technology companies doing this. Facebook has done it, Zillow, Spotify, Lyft most recently. You've gotten a lot of companies that are using this dual class structure, following Google's model or, tweaking it in some way. And that, bringing us to today, has precipitated the most recent wave in backlash and outcry over dual class structuring. And that, that's where we are now.
And I believe Snap, as you discussed in the article, has really broken the mold by only issuing non-voting shares to public shareholders. So you can't even get a vote if you want to go as a public shareholder.
Yeah, exactly. I think Snap was really the last straw for people who had been watching this trend. Google, then Facebook, and and so on, and who were alarmed. And then all of a sudden, Snap became the first company to issue only non-voting stock to the public. So, exactly as you said, that no person buying a share of Snap will ever have any influence over the direction of the company. And people looked at this and were particularly alarmed because the people who had all the votes were these two young guys in their 20s, and they saw this as just a really terrible example of, a company with awful governance, and thought everything was really motivated critics of this trend in dual class structuring to start, rallying regulators, stock exchanges, the indices for some big changes.
So speaking of that last straw, what are some of the governance economic reasons that critics offer for opposing dual class stock structures and asking regulators, index providers, et cetera, to take a stand on them?
Yeah, so the people who are opposed, this even though the dual class has gone through all these different stages and been used for all these different purposes, the critics haven't changed very much, and their argument is pretty much the exact same as it was 100 years ago. So they say, this is really all about agency costs. So, when dual class stock is insulating a group of insiders, that's very likely to increase agency costs. So in the example you gave at the beginning, our corporation, somebody could have a 33% stake in the company, but have a much higher percentage of the votes. And so if your voting control is much higher than your equity stake, your incentives aren't going to be perfectly aligned with the shareholders, and that's going to affect decision making. So, if I have 50% or 51% of the voting power, but only a 2% equity stake, to take a really extreme example, I might be inclined to use my voting power to maximize my private benefits rather than look out for the shareholder welfare, shareholder value. This might distort my investment decisions. And this also impedes the market for corporate control, right? So when problems emerge, if these shareholders who are really bearing the cost of my distorted decision making, they're stuck. They can't do anything. They can't sell to outsiders who can come in and wage a hostile takeover. They can't get hedge fund activists can't do as much. So this is all about agency costs, and they point to by contrast, under one share, one vote, you get this nice natural alignment of incentives between the decision makers and the shareholders. So if I'm an insider and I want to be in control, I need to keep a controlling equity stake, and I'm going to really bear a substantial proportion of the costs and benefits of the decisions that I'm making. And, if I don't decide to keep control, I sell down my stake and I, start making worse decisions, that a majority of shareholders can vote me out of office. So, this is sort of how the argument has gone over time, and it continues to this day to sort of take this form.
One difference from 100 years ago is the role of index investing and passive mutual funds and ETFs, and the role of index providers in corporate governance. How has that made a difference in this current iteration of the debate over dual class equity structures?
Yeah, so I think as I've sort of described, that the history of the use and regulation of dual class stock kind of shows us that it's the use of dual class stock is responsive to different market conditions. And I think that we're at a period in which dual class stock can be harnessed to deal with a new market phenomenon that may already be causing problems, but is likely to do so in the future. And that's, the rise of passive investing. So in the last 10 years, there's been a lot of concentration in voting power with these largely passive investors. And I use the term passive to refer to mutual funds that adhere to an indexing strategy. So exchange traded funds and index funds are the two main passive investors. And those funds, they don't seek to beat the market. They instead promise investors that they're going to track the performance of their baseline index as closely as possible. And that's a great thing for investors. This is the reason why they've become so powerful, is because investors have been flocking to index funds, which give them the ability to broadly diversify, but also charge really low fees. So, again, the reason why they've become so powerful is because they really do offer investors a lot of benefits. But, I've written elsewhere that this rise in indexing has some negative implications for corporate governance. And that's because these passive funds don't have the same financial incentive to invest in firm-specific information, to invest in stewardship. For one, index funds aren't trading their shares. They're not buying and selling based on how they think the company is going to do. They don't. That's one of the reasons that they're so cheap for investors. They charge investors such low fees, is they're not hiring analysts to gather firm-specific information. But I think that makes them particularly likely to be uninformed. And they also there's something about the nature of index fund competition. They compete with other funds based on relative performance, which basically means that if I am an index fund that is investing in stewardship, it's investing in firm-specific information, et cetera, I'm going to benefit all my rival funds, which tend to have the same percentage of share ownership of the same companies. And so I'm going to benefit my rivals while only I will be bearing those costs. And so that's going to lead me to not want to engage in governance. So as I talk about in this paper, I think that the rise in dual class structuring could be responsive to this problem and allow companies to sort between their investors, passive investors versus informed investors. And if you have the passive investors holding non-voting stock, you're actually going to benefit the company and reduce your agency costs.
On the ground, in kind of this battle between the visionary founders and the critics of dual class equity structures, who's kind of winning? What's the state of play, or is it kind of at an equilibrium at this point?
Yeah, so the critics had some big victories this year, and in particular, the Council of Institutional Investors, which represents a lot of mutual funds and pension funds and other institutional investors. They really led the charge against dual class company structuring. They directed their criticism in a lot of different directions, but they got real traction from the indices. So as of, I think now, I forget the exact dates, but pretty recently, FTSE Russell, S&P, Dow Jones, and MSCI have all sort of, in different ways, reduced the influence that dual class companies have in their methodology. So FTSE Russell and S&P, Dow Jones actually said, we're going to take dual class companies out, so that if you want to make it into the S&P 500, you can't be dual class. And MSCI reduced the weight that any dual class company would occupy in their index. And this is predicted to have a big impact because, as I mentioned, this phenomenon of index investing, a lot of money is flowing into index funds. And so being listed on, the S&P 500, the Russell 3000, whichever index you choose, being listed there is a huge driver of demand. So these exclusion policies or, reduced weight policies means that if you do decide to go public with a dual class structure, you're not going to get as much demand for your shares by virtue of being excluded from some of these major indices. So that was a big victory. Those were big victories for critics of dual class stock. This Council of Institutional Investors and other opponents have directed their attention and towards the SEC and stock exchanges as well. Jay Clayton has said he's watching the space. He's not acting now. So, who knows what could happen in the future. But just so far, the indices they've gotten the most traction there.
So the critics now and 100 years ago have argued that dual class structures will tend to entrench management and impose agency cost on shareholders who don't have outsized voting power. Your article is interesting in that it offers, I think, a more hopeful account for non-voting shares' potential impact on governance and firm value. Could you walk us through that, and how does your insight differ from some of the prior defenses that folks have offered, some of the prior justifications that folks have offered for dual class stock?
Yes, so this is the insight that I'm hoping to people will take away from this project is that dual class has been thought of as an entrenchment device, and I illustrate how you could actually use non-voting stock as a non-entrenchment device. So, again, the key insight is that not all shareholders are the same. Some are informed about the company. They're interested in participating in governance. And there's another category of shareholders, which I call weakly motivated shareholders. And those shareholders suffer from collective action problems that basically make it irrational for them to learn about the company or incur any costs, necessary for stewardship. So I explained to you just now about why I think a lot of passively managed mutual funds fit in that category. There's also a lot of retail shareholders would fit in that category. The people have been talking about the collective action problems facing retail shareholders for a long time. Why would you, if you own a couple shares in Microsoft, ever want to invest the time necessary to vote in a shareholder election? And this is supported by the evidence that most retail shareholders don't vote. I think something like 30% do on average. So it's inefficient for every shareholder to hold the same voting rights. So you can actually use non-voting shares to sort between your shareholders and use them. If you were able to issue non-voting shares and have all of the weakly motivated shareholders buy them, you're actually going to improve the efficiency of your corporate governance, and you're going to reduce your agency costs. And that's because the non-voting stock is going to amplify the voice of the company's informed investors. So, again, if I'm a company and I issue non-voting stock for all of my weakly motivated shareholders to buy, informed investors are really going to like that. And they're going to like that because their vote is going to be worth even more. So when problems emerge at the company, those informed outside investors are going to be able to come and vote management out of office, bring shareholder proposals, you name it. They can use those votes to get real change. It also improves the market for corporate control. They can sell to outsiders who can use those strong votes to do the stuff that they can't do. The holders of the non-voting shares are also going to benefit because those shareholders, by definition, don't value their votes at all. They don't want to be voting. It's costly for them to do it. So they get this, discounted product that allows them to sit out of governance altogether. They also get, of course, the benefit of, having the informed investors doing the work for them. So, this insight here is that if you use non-voting stock to sort the investors by, their information and their motivation, you're going to make your corporate governance more efficient rather than less. So this differs a lot. As you mentioned, this is really different from what people have said, what the previous defenses of dual class stock are, because, other defenders of dual class stock, they look at the world as it is. They say sometimes it's efficient to insulate insiders. Sometimes it's helpful to give the visionary founders control and not have them vulnerable to market pressures. And they take an increase in agency cost as given. They say, even though it may be that Mark Zuckerberg is going to do some stuff we don't like, and there's some problems there, the overall benefits are worth that increase in agency cost. So here, this is coming from a really different angle because it's not thinking about using dual class to keep power with insiders, but instead to actually improve and strengthen the voice of outsiders. That's the basic insight.
It seems like there are two paths then that dual class structures can go. One is the classic story of management entrenching itself, which can create added agency costs that shareholders with minority or no voting rights bear. And then you offer a model that does just the opposite. Both outcomes seem plausible as paths for any given company adopting this sort of structure. What conditions separate those two paths? How can we identify when a company is using a dual class structure to enhance firm value and reduce agency costs versus when it's engaging in entrenching behavior that might be destructive to firm value?
So to get that nice reduction in agency costs that I'm talking about, you need to ensure that the outside shareholders have a meaningful amount of votes. So you'd need to look and see how the dual class structure is being used. If it's just doing what Snap did and keeping all of the votes of the company's insiders, Snap isn't out there using dual class to try to, as a bonding mechanism to show they're in tune with their shareholders. They're using it to silence their shareholders. And to be clear, I don't have an example of a company that's doing exactly this. I think that that's sort of an interesting puzzle in itself, given the benefits that using non-voting stock in this way provides. Why aren't more companies doing that? But you need to have a company who said, look, we are really wanting to demonstrate that we are aligned with our shareholders, or, maybe it's a way of signaling our quality. And for that reason, we're going to make sure that, a majority of the votes are in the hands of outside shareholders, and that this non-voting stock is being used not to silence outsiders, but to further empower the voice of the outside shareholders. And even though, I think none of the companies that have used dual class stock thus far have done this, they're not using non-voting shares to improve their accountability. There are other efficiency benefits that are possible. So, even if you're not keeping all of your shares, the majority of your voting power with outsiders, you do get some efficiency benefits from doing what Alphabet did, for example. So remember, Alphabet has the 3 classes of shares, and they allow outsiders to have to buy either Class C, which is non-voting, or Class A, which is low voting. So even though, they're not doing that, there's no agency cost reduction there because all of the insiders keep voting control. There is an efficiency benefit because people that don't value their votes, these weakly motivated shareholders, can buy the non-voting shares, and they can just free ride without incurring any costs associated with voting. So that's a much smaller benefit, but maybe something that is going on with some of these companies that issue 2 classes of a non-voting and a low voting class to the public.
Yeah, that sounds like I think a very reasonable structure that we might see more of, that a company either decides to go public with an option of buying a voting share or a non-voting share, or maybe a company does some sort of split and issues non-voting shares. And I, as a retail investor, for example, might be inclined to buy the non-voting share because it's probably slightly cheaper because it doesn't have that voting right attached to it. And rationally, I'm not going to vote anyway. So why would I want to pay extra?
Right. When I was researching this, I was looking at all these Seeking Alpha message boards and reading these investor discussions. Should I buy Alphabet A or should I buy C? And people would write and say, come on, of course you want the non-voting. It's cheaper, it's discounted, and you get the same cash flow rights. Plus, who cares? Who wants to exercise the vote? So if you are weakly motivated, non-voting shares are great for you. And this is why, it's in some ways surprising we haven't seen more companies trying to use non-voting stock in this way. And the sorting that I was talking about, it will happen naturally for this very reason. The fact that voting stock trades at a slight premium to non-voting stock means that if you don't value your vote, you're always going to be lured. Well, not always. There may be moments when this wouldn't happen perfectly, but there's a lot of weakly motivated shareholders should be lured to buy the non-voting stock. And actually, if you look at the percentage of retail shareholder ownership of Alphabet A and Alphabet C, there are more retail shareholders that buy the non-voting stock.
That's an interesting empirical observation that kind of helps demonstrate that when investors, particularly retail investors, are given this option, they do act and as we might expect they would. Dorothy, this has been a great conversation. If you have any takeaways for markets and investors or for academic listeners, what would those be?
So, yeah, there's a couple takeaways. I think my main takeaway here is that sometimes these blanket good governance initiatives or restrictions, such as the ban on dual class stock that has been implemented by a lot of these indices, those can be really harmful. They impede efficient structuring for companies and cut off innovation and governance. So my theory as to why we haven't seen companies using dual class stock in the way I'm saying, despite the very clear benefit, is that dual class stock has a bad name. Non-voting stock has a really bad name. If you go public with a dual class structure, the Council of Institutional Investors starts lobbying against you. You might not get your shares listed on major indices. You attract all sorts of bad attention. And that, I think, cuts off innovation and governance, and it reduces tailoring for specific companies. So again, this is my guess as to why we haven't seen more experimentation in different dual class structuring because of this blowback. And so, I think it's always good to be skeptical and a little critical when someone tells you, oh, this is good governance and this is bad governance, and that any given blanket governance restriction is going to be beneficial for all companies.
It's good to always look for maybe the counterintuitive response to claims
Exactly.
like that. Our guest today has been Dorothy Lund, Assistant Professor of Law at the University of Southern California's Gould School of Law. We discussed her article, Non-Voting Shares in Efficient Corporate Governance, which was recently released in the Stanford Law Review. I'll include a link to that article in the episode notes for today. Dorothy, thank you for joining the Business Scholarship Podcast.
Thanks so much.